The paper silver price is acting calm, but the real market just started screaming. And there's a reason a lot of people would prefer you never notice the difference between those two sentences. Because when premiums jump and the screen price doesn't follow, it looks like nothing is happening. Right up until the moment the benchmark price is forced to catch up in a way that feels violent, unfair, and totally out of nowhere. And the hidden mechanism behind that snap isn't emotion, it isn't rumors, and it isn't some magical shortage headline. It's the plumbing, it's the spreads, it's the silent math of who has to find real ounces when promises stop netting out. And if you watch the right signals this week, you'll know whether this is a temporary retail flare-up or the early stage of a paper versus physical convergence event that rewrites the chart. But the next detail is what flips the whole setup. Premiums don't jump for no reason. In commodity markets, especially metals, a premium is the market's blunt way of saying, we don't have the thing you want, where you want it, in the form you need, on the timeline you demand. It's not a feeling, it's a constraint. And when that premium expands suddenly, it's usually not because everyone collectively got excited at the same time. It's because one part of the chain got pinched and then the pinch traveled. Dealers tighten. Wholesalers widen their quotes. Fabricators prioritize larger accounts. Retail shelves thin out. Delivery times stretch, and the premium becomes a visible scar. That's where the real pressure starts. Here's the part most people miss. There are two silver markets running simultaneously, and they only pretend to be one market when inventory is comfortable and the pipes are flowing smoothly. The market you see on your screen is a paper market. Futures, forward, swaps, unallocated accounts, and a whole ecosystem of hedges that can be rolled, netted, and offset. It's fast, it's liquid, it is perfect for price discovery in calm conditions, because it can absorb a lot of opinion without forcing anyone to move metal. The market you feel in premiums is physical. Coins, bars, wholesale good delivery bars, industrial feedstock, and actual delivery schedules. It's slower. It has frictions. It has minimum lot sizes and specific acceptable forms. And it has one ruthless rule. If you can't deliver what's promised, price discovery stops being a debate and becomes a scramble. But that's not the part that matters. The part that matters is that these two markets can diverge for longer than most people think, because the paper market has safety valves that delay the moment of reckoning. So when you hear paper prices lag behind, don't translate that into the futures market is fake. Translate it into something more precise and more useful. The benchmark can stay clean longer than reality because it can satisfy demand with exposure first, and only later with metal, if and when someone insists. That's not a conspiracy, that's how the structure is designed. Most participants don't want delivery. They want hedging, price risk transfer, inventory financing, or speculation. That means the system can net a ton of activity without ever pulling a single bar out of a vault. So spot can look sleepy while physical tightens under the surface. And then one catalyst arrives: calendar, positioning, delivery window, liquidity thinness, and the whole thing reprices quickly. Because if this one level breaks, the math changes. Now let S put the spotlight on the hidden detail that reframes everything. Silver can exist in the world and still be missing in the place that sets the paper price. That sounds like wordplay until you realize commodities aren't just about quantity. They're about location, form, and willingness to mobilize. You can have plenty of ounces sitting in long-term holdings, in jewelry and industrial scrap not yet processed, in regions where export isn't economical, or in forms that aren't readily deliverable into the benchmark system. That silver is real, but it's not available. It's not mobilizable at the posted price and timeline. So what happens? The physical buyer pays up, not because silver vanished, but because the silver that can actually solve their immediate problem is scarce. And once that scarcity shows up in premiums, it is a warning flare. The benchmark price may be underreporting the true urgency, because the benchmark is not being forced to clear the physical market. Yet. Yet is the dangerous word, because the calendar eventually forces yet to end. Let's talk about why paper lags in practical terms. A futures price can stay anchored by liquidity and by the ability to roll exposure forward. If you're long and you don't need delivery, you can roll. If you're short and you don't want to deliver, you can buy time by rolling, borrowing, sourcing later, or offsetting elsewhere. The system is designed to reduce delivery events because delivery is expensive and operationally messy. And in many metal markets, most open interest never goes to delivery. It gets closed, rolled, or cash settled through ordinary market behavior. That's a feature, not a bug. But when physical stress rises, the stress doesn't immediately show up in the front month print. It shows up in the differentials, the spreads between where metal is needed and where it sits, between spot and futures, between regions, between allocated and unallocated, between wholesale bar availability and retail product availability. The price is lying and the spread is telling the truth. And if you ignore spreads, you're watching the movie with the sound turned off. Here's the mechanism that turns Premium jump into benchmark catches up. Someone, somewhere, gets assigned the job of sourcing real ounces. In the paper world, that assignment is often hidden inside what looks like a boring basis trade or a routine hedge. But when the basis moves, when the relationship between futures and spot changes, when the cost to get metal now rises relative to later, the system starts forcing behavior. Dealers hedge inventory. Market makers manage their risk. Arbitrage desks scan for mispricings. Refiners schedule runs. Logistics firms price capacity. And when the physical market tightens, those desks don't just shrug. They adjust spreads, they widen quotes, and they sometimes have to bid up the nearby market to avoid being short, something they can T-source quickly. That's where it gets ugly. If you want the cleanest tell that physical is pressuring paper, watch the term structure, the curve. In a comfortable market, time has a cost. Storage, financing, insurance, handling. That usually expresses itself as contango, where future prices are a bit higher than spot. But when a market is stressed in the near term, something weird can happen. The market starts paying you to have the metal now. The curve flattens or even inverts. Inversion, backwardation, doesn't have to be huge to matter. It's a signal that immediacy is scarce. It's the market saying, the next ounce delivered now is worth more than an ounce promised later. And that changes incentives immediately. People who might have been happy holding paper exposure start questioning whether paper is enough. Holders of physical become less willing to part with it. Shorts become more nervous about rolling. And spreads start screaming even if the headline price looks normal. But that's not the part that matters. The part that matters is what this forces participants to do this week. Now layer in the inventory reality, because this is where a lot of retail narratives go off the rails. You'll hear people say, there's plenty of inventory, or look, the vault numbers are huge, and they'll be right in the most useless way possible. In metals, not all inventory is equal. The only inventory that matters in a squeeze is inventory someone is willing and able to deliver into the system that us being stressed. In major vault reporting frameworks, there is often a distinction between metal that is deliverable against contracts and metal that is simply stored there but not designated for delivery. Think of it like the difference between a parking lot full of cars and a dealership Unaumaoka S sellable inventory. Same objects, different availability. Some metal is held for clients who are not selling, some is pledged, some is earmarked, some is in a form that would require conversion. So headline inventory can look comfortable while deliverable inventory quietly tightens. And when deliverable tightens, you can see it first in premiums and spreads, because the people who actually have to make delivery or meet physical demand are the ones feeling the pinch. The chart won't tell you that until later. The premiums tell you now, and that's where the real pressure starts. Let's bring in the global angle, because silver isn't a local story. Silver is a global arbitrage story that plays out in shipping schedules, financing costs, and regional demand pulses. When one region is consistently paying meaningfully more for immediate silver, whether that shows up as a high local premium, a stronger bid for certain bar sizes, or tighter wholesale availability, arbitrage becomes a vacuum cleaner. Traders look at the price gap and ask, can we buy metal where it's cheaper, ship it, finance it, and sell it where it's expensive? If the answer is yes, metal moves. If the answer is yes, but, the but becomes the reason premiums persist. The but might be transport constraints. It might be conversion constraints, wrong bar size, wrong purity spec, wrong brand list. It might be financing constraints if credit tightens or if rates make carry expensive. It might be regulatory and documentation frictions. It might be time. You can fix a near-term shortage with metal that arrives in 6 weeks. So the premium can stay elevated even if global supply exists. And that's the hidden detail again. Wrong place, wrong form, wrong time. This is why you can see the physical market veto the paper market without needing to accuse anyone of anything. Incentives alone explain it. The paper market is optimized for risk transfer and liquidity. The physical market is optimized for supply chains and real-world constraints. When they disagree, the disagreement shows up as a wedge. Paper says one thing, physical says another. For a while, both can be true within their own domains. But eventually, the wedge gets too wide and someone arbitrages it, or someone is forced by calendar mechanics to close the gap. That's when you get the snap. So what's the why now? What's the trigger that turns a slow burn premium story into a chart story? Watch the calendar because the calendar is the catalyst. Metals markets have moments when behavior becomes forced. Month-end and quarter-end balance, sheet sensitivity option, expiry and dealer gamma exposure, futures, expiration and delivery windows, fund rebalancing cycles, and the thin liquidity pockets where a relatively small flow can move price more than it should. This week, this month, whichever window you're in, matters because liquidity thins and risk limits tighten right when deadlines approach. Dealers don't want to carry certain risks over reporting dates. Funds adjust exposure at month end. Options positioning can flip from dampening volatility to amplifying it if certain strikes get pinned and then broken. And when that happens in a market with physical stress, you can get a feedback loop. Price moves, hedging flows accelerate, spreads widen further, and the physical side tightens because everyone becomes more cautious at the same time. The next detail is what flips the whole setup. The paper market can ignore physical stress until it can T, and the can't is often a calendar event. Now, let's stack proof the way a skeptical finance brain demands it. Because one argument is entertainment, 5 arguments is conviction. First proof point, premiums expanding in multiple channels is rarely just a retail meme. If you see it in local coin shops, then in online dealers, then in wholesale availability, and you also hear about longer lead times or tighter buyback terms, that's a chain signal. It means supply is not instantly replenishing at the posted screen price. Second proof point, spreads and differentials. If the relationship between near-term delivery and later delivery changes, or if spot versus futures dynamics start acting off, that's the market pricing immediate scarcity. Third proof point, inventory composition. Even if total stocks don't look dramatic, if the portion that can be delivered or mobilized tightens, the system becomes fragile. Fourth proof point, regional price divergence. If one region is persistently bidding up physical, arbitrage will try to pull metal and that tightens other regions. Fifth proof point, chart structure. You don't need perfect numbers to respect the pattern. A market that can break down on bad news, that holds higher lows, that keeps reclaiming previous resistance zones, is often a market being supported by non-emotional flows, and that's where the real pressure starts. Let's translate the mechanics into so what. Suppose physical demand tightens and premiums stay elevated. What does it force participants to do? It forces dealers to protect inventory. It forces market makers to widen spreads. It forces shorts to manage the risk that rolling becomes more expensive or less reliable. It forces industrial buyers to secure supply earlier and more aggressively. Because in manufacturing, the cost of being short physical input is often larger than the cost of paying a bit more. And it forces arbitrage desks to calculate whether the premium is large enough to justify moving metal and converting forms. That is not a debate, that is price discovery. And when all of these forces align, the paper price lag becomes unstable. Because paper can only lag physical as long as enough participants accept exposure instead of insisting on metal. The moment that preference shifts even slightly, the system starts to creak, but that's not the part that matters. The part that matters is how that creak shows up before the snap. One of the earliest tells is the behavior around key levels on the chart, not because the chart is magical, but because positioning is real. Markets have zones where risk managers change their rules, zones where option dealers change their hedges, zones where trend followers re-enter, zones where systematic funds adjust leverage. You'll often see silver drift toward a level that should reject price. And instead of rejecting hard, it hesitates, pulls back shallow, and then grinds through. That grind is the sound of absorption, someone taking the other side, patiently, repeatedly. And when absorption is paired with physical stress, it suggests the market is not just trading narratives, it's trading constraints. Because if this one level breaks, the math changes. Dealers hedging can flip from stabilizing to destabilizing. Shorts can move from comfortable to cautious, and physical buyers can move from we can wait to we can risk it. That's when the move stops feeling gradual. Now, let's address the counterpoints, because credibility lives here. Premiums can jump for reasons that don't end in a sustained rally. Retail product bottlenecks can be a temporary manufacturing issue, mint capacity, blank shortages, distribution delays, without implying wholesale bar tightness. A sudden surge in fear buying can widen premiums even if industrial demand is steady. A strong rally in the paper price can also widen premiums temporarily because dealers lag in repricing inventory, not because metal is scarce. And markets can deflate fast if liquidation hits, if broader risk-off forces funds to sell metals to meet margin calls elsewhere, or if the dollar strengthens sharply, or if yields spike and pressure all non-yielding assets. Silver is notorious for whipsaw. It can punish both bulls and bears. So the honest posture is this: elevated premiums are a warning sign, not a guarantee. The question is whether the warning is isolated or systemic, and you can tell the difference by watching whether spreads, inventory composition, and regional divergence confirm the premium story. If they don't, the premium could cool without the benchmark doing anything dramatic. If they do, the benchmark is living on borrowed time. The next detail is what flips the whole setup. Even in a true bull setup, silver can drop hard first. That brings us to the 2 scenario lens, because if you want to keep trust with yourself and with reality, you need a framework that doesn't collapse when price does something rude. Scenario 1 is the controlled pullback and retest. In this scenario, paper price pulls back toward a prior support zone, Volatility spikes, headlines turn sour, and the crowd gets emotionally shaken out. But the key is what doesn't break. Premiums remain relatively firm. Spreads don't normalize completely, and physical availability stays tighter than normal. That's the market telling you the pullback is mostly noise, a liquidity event, not a thesis break. It is the market trying to scare you out of the position before the structural pressure expresses itself in the benchmark. Scenario 2 is the continuation squeeze. In this scenario, price pushes through a key resistance zone and accelerates, not because everyone believes, but because the hedging math forces buying into rising price. Dealers who were short calls hedge by buying futures. Shorts cover into thin liquidity. Momentum systems add exposure. And the move can gap because there simply aren't enough resting offers when everyone tries to adjust at once. This scenario comes with gap risk in both directions. It feels exhilarating until it doesn't, and that's why risk management is not optional here. Because the same mechanics that can push price up fast can also pull it down fast if flows reverse, and that's where the real pressure starts. So what do you actually watch next week, next 2 weeks? If you don't want to be a hostage to feelings, watch the relationship between premiums and spot. If spot chops sideways, but premiums stay elevated, that's a signal physical demand isn't satisfied at the screen price. Watch spreads and the curve, whether the nearby market stays supported relative to later months. Watch inventory composition changes and, more importantly, the tone of the market. Are bids getting more aggressive for immediate delivery? Are offers thinning? Are quotes widening? Watch regional signals, whether the physical bid in key hubs persists, because persistent regional divergence is what powers arbitrage, and arbitrage is what eventually drags the benchmark. Watch how price reacts at obvious chart zones. Not the exact number. Your platform might show slightly different prints anyway, but the behavior. Does silver get rejected hard and stay rejected, or does it get rejected, dip, and then reclaim quickly? Reclaims are information. Failed breakdowns are information. And when those behaviors align with physical stress, the probability of a catch-up move rises. But that's not the part that matters. The part that matters is what would invalidate it. Here is an invalidation concept that keeps you grounded without pretending you can forecast with perfect precision. If premiums collapse back toward comfortable levels, while spot remains flat or falls and spreads normalize and availability improves quickly, then the physical stress narrative weakens. It doesn't mean silver can't still rally later. It means the specific paper lag story loses urgency. On the other hand, if premiums remain sticky even through a paper pullback, and if the nearby curve stays supported, and if regional bids remain firm, then the stress is likely real, and the paper price is simply late. That's the cleanest logic you can use without needing perfect data, and it keeps you from turning this into a religion. Because the market AOS favorite trick is to make you bail out right before the stress shows up in the benchmark price, and it does that by weaponizing volatility. Let's talk about that weaponization, because it means the difference between being right and making a decision you can live with. Silver is a volatility machine. It is famous for making people feel like geniuses, and then punishing them for believing the feeling. If you buy into excitement, it will dump on you. If you sell into fear, it will rip without you. That's not because the market is personal. It's because silver is relatively small compared to giant pools of capital, and it trades like a market where liquidity can thin fast. That means price can whip around violently, even if the thesis is correct. So you need a psychology shield, separate trend signal from noise. Trend signal is what persists across time frames and shows up in structure. Higher highs and higher lows, strong reclaims, persistent physical tightness, sticky spreads. Noise is the intraday spike, the headline of the hour, the shakeout candle designed to trigger stops and margin calls. And if you confuse noise for trend, you'll hand your decision-making to the worst possible moment. Panic. Your shield is a checklist, not a prediction. Your shield is position sizing that doesn't force you to sell at the bottom. Your shield is refusing to anchor to one perfect entry. And that's where it gets real, because nobody likes hearing that discipline matters more than the call. But it does. Now zoom back out and connect this to macro, because silver never moves in a vacuum. Silver sits at the intersection of monetary sensitivity and industrial reality. It responds to real rates, to dollar strength, to risk appetite, to inflation expectations, and to recession fears. It also responds to industrial cycles, electronics demand, solar manufacturing dynamics, and broader supply chain conditions. And that mix makes it unpredictable in the short run. You can have a world where inflation is sticky and that supports hard assets, but growth fears hit and that pressures industrial metals, and silver gets pulled between narratives. That tug of war can keep the paper price range-bound even while the physical market tightens for specific reasons, regional procurement, fabrication constraints, or inventory unwillingness. So don't a T make the mistake of thinking the paper price not moving means the physical signal is meaningless. Sometimes the paper price is simply being anchored by macro crosswinds, while the physical market is quietly tightening underneath. That's why you watch the spreads, because spreads are less opinionated. Spreads are the market whispering what it can't yet shout. And here, it's the cinematic but finance credible truth. When physical constraints collide with paper positioning at the wrong time on the calendar, the move doesn't ask permission. It just happens. A lot of people will explain it afterward as news, but the news is usually the excuse, not the cause. The cause is that the system became fragile and one shove hit it. That shove can be an options expiry where dealers are forced to adjust hedges. It can be a month-end rebalance where a fund must buy or sell regardless of feelings. It can be a delivery window where someone can't roll as easily as they assumed. It can be a sudden drop in liquidity where an order that would normally be absorbed now pushes price. And once price starts moving, reflexivity takes over. Rising price attracts attention, attention attracts flows, flows force hedges, hedges move price further, and that's where the real pressure starts. So if you're sitting here watching silver premiums jump while the screen price lags, don't treat it like a weird trivia fact. Treat it like a stress test result. The physical market is telling you something about immediacy, availability, and trust in the chain. The paper market is telling you something about liquidity, positioning, and netting. When those two messages diverge, you don't need to pick a side emotionally. You need to monitor the junction where they are forced to reconcile. That junction is spreads, term structure, inventory mobilization, and calendar deadlines. And if you get those right, you'll stop being surprised by moves that the crowd calls sudden, because they're rarely sudden. They're compressed. Here's a concrete roadmap for the next week or two, without pretending to hand you guaranteed outcomes. First, identify the nearest obvious support zone and resistance zone on your chart. Whatever your platform shows, the concept matters more than the exact print. Support is the area where price has recently bounced or consolidated. Resistance is the area where price has recently failed. Now watch behavior, not hope. If price approaches support and premiums stay elevated, spreads stay firm, and the bounce is decisive, that's a constructive signal. If price slices through support and premiums and spreads collapse with it, that's a warning that the physical stress was more retail, micro, than systemic. Next, watch for a reclaim. Reclaims are powerful in metals. A breakdown that fails and then reclaims is often a sign that sellers were more liquidity-driven than thesis-driven. And if a reclaim happens during thin liquidity or around an options or futures window, the move can accelerate. That is the payoff later in the video. The level matters because it nests where the hedging math flips. And please hear this part clearly. None of this is about worshiping silver or declaring a new era every time something tightens. This is about respecting that markets have structure, and structure creates predictable pressure points even when direction isn't guaranteed. If you're a skeptic of institutions, keep that skepticism pointed at incentives, not fantasies. Institutions don't need to be villains for the system to behave in ways that look unfair. A market built on netting promises will always lag a market built on physical constraints until a deadline forces convergence. That's not a moral claim. It's mechanics. And mechanics is where you win or lose. If you've watched this far, you are already doing the most important thing most people refuse to do. You are watching the market, internals, instead of its headlines. And that is the identity you want to build. A person who can sit through the noise because they understand the plumbing. So as this plays out, don't let volatility bully you into impulsive decisions. Don't let a red day convince you the thesis died. Don't let a green spike convince you it's risk-free. Hold the two scenarios in your head at the same time. Controlled retest versus continuation squeeze. Let the market confirm which one you're in through spreads, premiums, and structure. And keep a simple checklist. Are premiums still elevated? Are spreads still signaling near-term tightness? Is availability still constrained? Is price respecting or reclaiming key zones? And is the calendar pushing participants into forced action? Because if those answers line up, the paper price lag doesn't last forever. It snaps. And when it snaps, it moves faster than people think. Stay sharp, stay systematic, and stay allergic to narratives that demand you feel instead of think, because the moment you start feeling, someone else starts profiting from your panic.